Stop right there. If you're thinking about investing in the UK, don't do anything yet. Most beginners don't lose money because investing is hard. They lose because they don't understand how the UK system actually works. Taxes, accounts, strategy, all of it matters. And if you get it wrong at the start, you'll waste time and money fixing mistakes later. In the next few minutes, I'll break down exactly what you need to know before investing your first pound so you can avoid beginner traps and build something that actually grows. Section 1. The biggest mistake beginners make. Most beginners jump straight into investing without understanding what they're doing. They download an app, buy a stock, maybe follow a trend, and expect results. That's not investing. That's guessing. The biggest mistake is starting without a system. Not people focus on what to buy instead of how to invest properly. They ignore structure, risk, and long-term thinking. In the UK, this mistake is even more costly because there are specific tools and tax advantages that beginners don't use. Instead of building a foundation, they chase quick wins. Smart investors don't start with stocks. They start with understanding the system they're operating in. Section 2. Understand the UK advantage. The UK offers one of the biggest advantages for investors, but most people ignore it. It's called the ISA, Individual Savings Account. This allows you to invest without paying tax on profits, dividends, or growth. That means everything you earn stays yours. Over time, this makes a huge difference, but beginners either don't use an ISA or use it incorrectly. They invest outside it and lose money to taxes without realizing it. Before thinking about stocks or returns, you need to understand where your money is going. The right account can increase your long-term gains without changing your investment strategy at all. Section 3. What you should not do. Before you think about making money, you need to avoid losing it. Most beginners make the same mistakes. They chase trending stocks, follow random advice, or try to get rich quickly. They invest based on hype instead of logic. Another big mistake is trying to time the market. Buying low and selling high sounds simple, but almost no one does it consistently. People also invest money they might need soon, which forces them to sell at the wrong time. These mistakes destroy progress before it even starts. Investing is not about quick wins. It's about avoiding bad decisions that quietly eat away your results. Section 4. What actually works? What works in investing is simple, but most people ignore it because it feels boring. Consistency beats everything. Instead of trying to win big once, you win small over time. This means investing regularly into assets like index funds or ETFs. These don't rely on one company. They track the overall market. Over time, markets tend to grow, even though they move up and down in the short term. You're not trying to predict the future. You're building exposure to long-term growth. This approach removes emotion and reduces risk. It's not exciting, but it's reliable. And that's what actually builds wealth. Section 5. The power of compounding. Compounding is where investing becomes powerful. At the beginning, it feels slow and almost pointless. You invest small amounts, and the growth doesn't look impressive. But over time, something changes. Your returns start generating their own returns. Then those returns grow again. This creates a snowball effect. The longer you stay invested, the stronger it becomes. Most people quit before this phase because they expect fast results. But compounding rewards patience, not speed. Even small, consistent investments can turn into something meaningful if given enough time. This is how ordinary people build wealth without taking extreme risks. Section 6. the system. The real key to investing is building a system that works over time. First, focus on increasing your income so you have more to invest. Then, invest consistently, even if the amount is small. And use tax-efficient accounts like ISAs to maximize your returns. Reinvest any profits instead of spending them. This creates a cycle where your money keeps growing. The goal is not to rely on one big move, but to build steady progress. Systems remove emotion and make your actions repeatable. When you follow a system, results become predictable. That's how beginners turn small steps into long-term financial growth. Section 7. Reality check. Investing is not fast, and it's not easy money. There will be periods where nothing seems to happen. Some days the market goes down, and it feels like you're losing progress. That's normal. The difference between people who succeed and those who quit is patience. Successful investors don't panic during drops. They stay consistent. They understand that short-term movement doesn't define long-term results. If you expect instant outcomes, you'll get frustrated and stop. But if you stay disciplined, the results will come over time. Investing rewards those who stick with the process, not those who constantly change direction. Section 8. Where beginners should start. If you're just starting, keep it simple. Open a stocks and shares ISA first. This should be your base. Then focus on broad index funds or ETFs that track the overall market, like the FTSE 100 or global index funds. Don't overcomplicate it with too many choices. Start with 1 or 2 solid options and invest consistently every month. Avoid trying to pick individual stocks in the beginning. It adds risk without experience. Your goal is not to beat the market, but to build steady growth over time. Only once you gain confidence and understanding, you can explore more advanced strategies. But in the beginning, simplicity wins. If you're serious about investing in the UK, don't rush into it. Build the right foundation first, understand the system, and stay consistent. That's what actually works. And if you want to know exactly where beginners should invest their first money in the UK, watch the next video on your screen.